Well, we roll into the final month of the year, and what a year it's been. We look ahead at some massive event risks that we come through in December. But the bulls at the moment, the risk bulls that is, seem reinvigorated, and there's a resurgence coming through with new all-time highs, the 56th all-time high of the S&P this year, and the Nasdaq is looking absolutely beautiful at the moment as tech finds its mojo. Now, in the FX markets, we are seeing a bit of a consolidation playing through in the broad US dollar. Of course, we are looking ahead at that non-farm payrolls number on Friday. This is the start of some of the big marquee event risks as we go through the month. Now, we are looking at crypto. Bitcoin is back looking at that 100,000 level, and we ask whether or not it can break it this time around. Obviously, a lot going on. It's going to be a big December. This is the place to find out what is going on. This is the trade-off. Well, hi there, I'm Chris Weston from Pepperstone. I'm going to be joined by my good friend Blake Morrow from Forex Analytics, and we're going to discuss everything that's going on in the financial markets, the trades, the setups, the flows, the movers and shakers, as we progress through this final penultimate month of the year. Mr. Blake Morrow, when it comes to seasonality, you appease it more than anyone else. You are the man I look to go into December and close out what has been a fantastic year. How's it all going down on the trading floors for you?
I knew you do believe in Santa Claus. I knew it. You know, every year you choose not to believe, but I believe this year you are a believer of seasonal.
That's right, mate. I mean, I think the Santa Claus all the active managers are feeling he's coming to town, and you know that's all they talk about. So, absolutely, you got to believe in it, mate. But it's looking pretty good at the moment, isn't it? I mean, everyone's running the statistics at the moment and saying, well, you know, we're up 27%. Well, we bit less when we went into December, and you know, over the last 20, 30 years, when we've seen, you know, big gains coming into December, then that usually is the trigger point for actives to run the risk going into the market and dial up the risk if they're underperforming. But yeah, there's more than that. There's other factors which have resurfaced, which give us some fundamental tailwinds to the rally we've just seen, and make me believe that you know, this risk on rally in the Nasdaq and the S&P is there for chasing. So it's probably a good idea to cut back and have a quick look at what's going on in topical funder. Okay, Blake, let's start with December risk. We kind of briefly touched on it last week, but obviously our job as traders is to manage risk and do something about it when we see those risks. But obviously we can prepare for what potentially could be high volatility and changes in the sort of the market dynamic and trading environment in which we operate on. You know, we are looking at the VIX, which is trading at 13%. FX vol has started to rise and you know, sort of year-to-date range highs, which is good, I guess, for us. I think that sort of speaks to the idea that the market is perceiving central banks to do different things over the next 12 months, and those dispersions cause high volatility. But yeah, are we due for a high VIX? Yeah, we'll have to see. But you know, we are looking at, well, obviously we've got payrolls on Friday, which we can discuss in the bottom of the segment. We've got you've got the CPI numbers next week, which could really influence the idea about the Fed looking to cut 25 basis points on the 18th of December. Look, we expect the Fed to do so. I mean, Christopher Waller, one of the more influential governors, has said that he is leaning on that. You know, Powell's probably sort of leaning on that as well. But obviously CPI and payrolls could be influential there. Then we go into the Central Economic Work Council Committee in China on the 11th to the 12th of the month. And then we've got these sort of 8 or 9 different central banks that come through, most expected to change policy. You know, there's some which we could see even, you know, conjecture about exactly what happens there, which could cause some volatility. You know, we're talking Swiss National Bank, we're talking ECB, for example. So it's and also the Bank of Canada. So look, it promises to be some lively month. Is volatility incorrectly priced at these current low levels? We'll have to see. How are you sort of talking to your clients about to prepare for this event risk, Blake?
Well, you know, can we jump to the next section, please? I'm joking.
No, we can't.
We're going to have to
address it.
We're going to have to feed into the next section, so you guys got to stick around for it. But, you know, it was interesting listening to Powell today, talking at the New York Times Deal Book conference, and he was, you know, surprised about how strong the U.S. economy was going into the month of September and October. So it's going to be really interesting to see if the data can keep up with, you know, expectations right now. And Personally, I think that that there is a little bit of room for disappointment, and if there is room for disappointment, it doesn't necessarily mean that the markets will be disappointed. And that's the one thing that I think you have to keep in the back of your mind. There's a lot of seasonality tailwinds, as you pointed out. that I think is going to feed into the whole entire narrative of what we're going to be doing in this month. But you're right. There's so many landmines. The big one obviously is going to be non-farm payroll, especially after seeing the CPI and the services ISM today. There's a little bit of risk around the headline number, but it's not like I'm expecting any, horrendous number. And inflation continues to just kind of grind lower a little bit back to normalization. So, is there anything that's going to rock the boat between now and the end of the year? And that's where we start talking about the next topic, Chris, which we can move into the stock market.
Well, you've been gagging for this one, haven't you?
Yeah, I couldn't wait. I couldn't wait to talk about this because this is a big one, Chris. And trying to paint the narrative into the end of year, as you pointed out with asset managers. Look, if you're not up 30%. And we're coming into the last couple of months. I mean, you got to put some money to work. You just have to, regardless of what the narrative is, but or the economic data or what the Fed does. But there's a lot of, as you pointed out, there's a lot of central banks. But I want to talk about data specifically because we have non-farm payroll. That'll be this week. Let's say the number comes in a little weaker than expected. A little weaker than expected is fine. I mean, obviously, if you get a good number, that's going to keep stocks elevated. But even if it's, if the U.S. creates, 120,000 jobs, it may not meet up to expectations, but it's not super weak. So that's going to keep the Fed, a little bit looser. And then you got CPI. The CPI data. You look around and it could be in line with expectations, but really shouldn't rock the boat a whole bunch. So even any little dip, I think that narrative for the end of the year, that continued rally that we're seeing in the markets, I can't see it really changing unless there's some sort of landmine that a black swan that we don't see. I mean, how are you looking at the narrative going into the end of the year? Because I see that equities probably are going to continue to rally through the holidays.
I wouldn't be betting against it. Look, give me a payrolls number of 150 to 200,000. Give me that number. Give me an unemployment rate of 4.1%. Give me a fairly unchanged reading on the CPI, on core CPI next week, and I'll give you a rally into year end because we've got past the major hurdles. I'm fine with that, and you chase it. Tech's found its mojo again. Salesforce, I know it's a more software side of things, but what we love about Salesforce, what a company, what an absolute company. The stock is absolutely ripping. You've got to own it, in my opinion. It's hard to do at all-time highs, but what we love about this is there's been so much investment in the AI space, in the AI infrastructure. And these guys came out earnings last night and they showed that they're actually giving a return. They're getting a return now through Agent Force, right? And so this big sort of macro concern that this massive level of infrastructure spend and investment and capex has gone into this space, we may not generate the returns. Well, these companies have shown that they're doing it now, and that's going to get even higher. So that's addressing one of the issues, and they're a leader in actually monetizing AI now through the bots, agentic AI they call it. So that's really interesting. Plus, you had Marvell on the AI side last night up 23%. This has spilled over into Nvidia, which wants to push to new all-time highs. We've got the Mag 7 looking good. So we've seen that rotation recently into value. We've seen that into those parts of the market. Now what we started to see, given what we've seen there, is this resurgence back into tech and AI and semis and the software names especially. And CrowdStrike did well. If that can continue, it doesn't matter about poor market breadth, concentration risk. If tech's going to lead us higher into the end of the year, then we get that payrolls number 150, 200. We could talk about that set, but we get past these landmines without any kind of issues. The Fed still cuts, and you've got to be chasing. It doesn't matter about valuations. You can give a monkeys about that. If the index is going up, like you say, 30%. What's the S&P is 27% year to date. 30%. You probably wouldn't necessarily be chasing too hard, but you just want to be benchmark returns. But if you're up 25%. And your performance fees X 20% or so, you've got to dial up that risk, haven't you? And you've got to outperform. You've got to be above benchmark returns, and that's a really interesting one. The other factor is, Blake, just quickly, is it's not just the active. There are the mutual funds which will have to rebalance. It's been such a breathtaking year that the question for a lot of these big these big pension funds, these mutual funds, is they will have to rebalance stocks. The question is will they look to sell out those stocks and rebalance weightings at the end of the year or into December, which will offset those active returns, or do they wait like we've seen in previous years until January just to make sure they max out the effects for shareholder so that's a negative force, but one suspects they may look to do that in January instead. So that might be an interesting one there as well. Anyway, look, I agree. I think it's hard to bet against the Nasdaq at the moment, and the DAX as well. The German DAX is ripping. Love that market. It's doing everything right. Don't think less about the economics of Europe. Think more about why it's going up, and I love that. And I'm not using targets. Just let it rip, let it run, let it keep going. I think that's a market. Talking about let it run, let's go into Bitcoin, Blake, because we thought we might have seen a bit more of a pullback. I'm not a hodler or someone who's staunchly in love with the crypto scene. I just think it's a brilliant trading vehicle for expressing your view, and I love it from that perspective. And we got down to 92,000. The bull's a step back in. It's consolidated, but now we've made a resurgence back up to 99,000. We've seen Paul Atkins come in as the new SEC chair, and obviously everyone's been very excited because he's very pro crypto. And we've seen other Trump appointments in the last 24 hours, all who have expressed in the past very positive aspects of that as well. There's mining companies who've been increasing their coin allocations, inflows. All these factors are taking place, but I think the new win now is that Atkins is at the helm of the SEC, and what Bitcoin really needs is a really favourable regulatory regime coming forward, and I think people are sort of suspecting that. So is this now the time, Blake, to push above 100,000? Should we really even care? I know that if we have a look at the order book in Bitcoin, there's been loads of obviously heavily stacked with sellers at 100,000, but is this now the time? Is it just a number? Do we really care? How are you playing it?
Well, so I think Bitcoin and as you pointed out, these cryptocurrencies are very, very great vehicles to trade. They're great technically, and that's what I love most about them is they're just not. They act really well around technical levels. So the big level I've been looking at is 103,000. I know it's an oddball number, but it's also 161% extension, a major, golden fib extension level. So would there be some exhaustion above 100,000? I would think so, but that doesn't mean I would like to short it, because frankly, this is a bullish wedge breaking out, bullish pennant breaking out to the upside that looks like we've got a lot more juice left in the tank. But I would say that you start getting above 100,000, you got to be a little bit more careful, especially until we have President Trump taking office once again and seeing what their administration is going to do. I think it's going to be a lot of two-way action up around these levels, but why not be buying dips? I mean, pullbacks are shallow. When you have pullbacks that are shallow, that means that there's a lot of buying around. That means that dips are shallow. The trend is very much entrenched to the upside. So that's the way I'm looking at it, Chris. 103,000 is going to be a big level for me. And I know a lot of people are looking at 100, but I actually care more about 103,000.
Okay, so let it rip through 100,000 and leave your sell orders at 103 for a pullback. Maybe that's the point of. But obviously Kramer hasn't had his call yet work against him. He's obviously been another person bullish on crypto, but obviously the cliche around those calls. Anyway, let's. I suppose we'll take it from there. We'll see what happens. But I think is this the time? Perhaps there still needs to be a lot of wood to chop through the supply at those in the order book there. So it's an interesting one.
And you have to imagine, as you said about it, the order book, there's a lot of people selling at 100. It's a two-way market. There's a lot of people that are going to be selling there. They're probably looking to reload lower. So you got to imagine there's a lot of bids beneath the market as well. Anyway, we could talk on and on and on about crypto. And believe it or not, it's going to be coming up in a little bit too when we start going through some of the technical charts. But I want to talk about non-farm payroll and talk about the playbook because you kind of mapped it out. You're like, give me 150,000 to 200,000. It would be below expectation slightly, but unemployment rate at 4.1%. Look, that's a good number. I mean, you missed the headline a little bit. You're probably going to see some jostling around in the market, but you have to imagine this gives if there is a bit of a miss in the data, the dollar would probably weaken a little bit because, frankly, it would allow the Fed to, cut rates one more time in December. And I know the odds are pricing that in, but it also allows them to potentially, when they have their meeting here in a couple of weeks, in 2 weeks, to be a little bit more dovish and maybe even open that door a little bit bigger for more rate cuts into 2025. As long as the data is softening, but as long as they're still achieving the quote unquote soft landing, as long as we're not seeing an implosion of non-farm payroll. The way I really want to play it though, Chris, if you look at the euro, the euro's had every bad thing thrown at it. I mean, literally, collapse of the French government today. You got German government's going to collapse. You got economic data's on the fritz. Manufacturing is horrible. Yet the euro is trading above 105. And if you look at all the setups from with other dollar currencies, the dollar looks vulnerable, I think. And so as a result, I think any weak data, I think you can take your pick. And I really want to be long sterling, long euro even. And it seems wrong, but I mean, you can't really fight the fact that it's buoyant right now, like a beach ball underwater. Like you're trying to press it underwater, and it's just not going. You get tired, you let it go, and it pops above water. Anyway, what's your NFP playbook? How are you going to be looking at this Friday?
Yeah, pretty simple, to be honest. I mean, it's going to be a noisy number, potentially. I mean, certainly it's not as noisy as last month. But, yeah, I think, what's the number in my mind where people de-risk and stocks go down? You probably just take a number below 100,000, a pickup in the unemployment rate. Obviously, the unemployment rate's premised off the household survey as opposed to the establishment survey. So, the two are different to an extent. But, yeah, obviously, below 100,000, if the unemployment rate was to say push up to 4.2, maybe certainly 4.3, if we were to get that, then I think you're going to see equities down pretty hard, and we start then going into the new year thinking, we're going to see recession risk, like we do every year. We're saying, we're going to go in pricing a recession risk, and it doesn't happen. We get resilient, if not exuberant, US economy. Yeah, I think that would be the number that people go into the new year thinking, what if we get a trend, a hot number. I think the market absorbs that as well. I think, so that's the one that I think equities de-risk. Obviously, the dollar goes down. I think the Goldilocks number where, the market says that's great because we're going to get Fed rate cuts, but it's still strong enough to support is what I talked about, the 150 to 200 unemployment rate, 4.1, probably some cushion to get to 4.2. But I think, the other component is what happens. We see a number that is really strong. And of course, when we try and forecast payrolls, it's just finger in the air stuff. You just got to be open to all possibilities. It's a bit of a lottery. But, if we get above 250,000, which would be a big snapback, obviously, and that would be well above consensus, and the unemployment rate was at 4.1, 4%. What happens to risk then? Well, I would say that the market says, we've got a really bloody strong labour market. Let's put on risk, and that just propels the market higher. So 2 of those 3 permutations, equities go higher in that situation. So I like that's probably where I see the balance of risk. Really weak. It would have to be a really weak number for us to get truly concerned. Anyway, let's move on to the next one, which is that's a setup. Bada bing, bada boom. Let's start with NASDAQ. We talked a little bit about it, but we looked at the numbers from Marvell. Stocks up 24%. Obviously, a very small component of their various equity benchmarks, but the read through that we have into the AI plays, into your Broadcoms, your Nvidia. Certainly, Nvidia was up 3.5%. We're looking at we can rerun a pushback above 145 into the all-time highs. I really like Nvidia still for next year. It's missing personally. It's missing a bit of a spark at this point, but I think as we go into the Blackwell increase going into probably April, you're going to see consensus revenue expectations increase, and I think the share price will do very nicely on the back of that. But so I like what I'm seeing right now. I mean, the market is had a few days of sort of fatigue coming through. We saw the market looks a bit knackered, but the buyers have stepped back in. We've seen a 1% move there, and it's done so at all-time highs. We've still got the rising up trend in place. For momentum, we can see a rate of change, 2-day rate of change is still pretty good. So I think pullbacks I'm happy to stay long this market. Just use something more of a sort of a systematic guide. Use the 5-day exponential moving average, which is ticking up nicely. A daily close below the 5-day exponential will probably be a reason to cut out. I think we maybe get some consolidation, if not, but a modest pullback. But as long as it can stay there, this impulsive move is here to be chased, and I think I'll stay long here.
Oh gosh, can we get a blow off top going into year end? Maybe Santa will bring that.
January holds. There's some strange things that happen at the beginning of the year. It's my birthday as well, so if anyone wants to send presents, I can give you my address. But we also get the new year. So I think the higher this rallies, the further it goes into year end, the greater the chance for a January craziness to happen. Yeah, is my opinion.
I would not disagree with you at all with that assessment, Chris. All right, I'm gonna switch it up a little bit, and I am gonna talk about the U.S. dollar CNH. It's not a currency I usually talk about, but I know, Chris, I'm gonna reluctantly mention my colleague Ryan Littlestone, and he's also on the UK show, the Trade Off show. He's been talking about the U.S. dollar CNH having this inverted head and shoulder pattern, and it actually completed. But the reason why I'm bringing it up, it's not because I trade it, because I can't as a U.S. trader. My broker doesn't allow it specifically, but I think it's something I know. But that's why you Pepperstone traders, you can. And this is a really important chart because now that we've completed, we matched those highs. We actually made a little bit of a false break, and we're reversing today with dark cloud cover. Next week, you pointed out the Economic Work Conference. I think it's next Wednesday in China, and you don't think it's really going to be a big deal, and it may not be. But there's been a lot of calls for continued stimulus, and maybe the yuan gets a little bit of a move here, and maybe the dollar shows us a way, over the course of the next couple of days. So I think there's room for it to come off back down towards the 200 DMA after completing this extremely big inverted head and shoulder pattern.
It's really interesting because I actually look at this currency quite a lot. I think it's really influential in G10, even though it is, obviously the CNY is managed. But if you go back to 2018, 2019, once we saw the Trump tariffs put in place, that's when we saw the devaluation. Obviously, a lot of free floating currencies, we try and price it in before the actual tariffs come in, and we do that well ahead of the game. As new news happens, we price it in real time. What happened in 2018 is the PBOC actually waited for the facts. They waited to kick in before they started to devalue their currency, and that's when we saw the 11% move higher in dollar CNH and CNY. And I think that's going to be the same this true. I think the PBOC and the Chinese policy setting authorities will wait until they actually know exactly what happens post January 20th, what tariffs are going to be put in place, what goods, how they're countering it, and I think that's when we start seeing the devaluation of the CNH. And if the yuan goes lower, that leads me into Aussie dollar. Please, Aussie dollar.
Yes.
Thank you. Because if the yuan's going low, the CNH and CNY is going lower, then the Aussie dollar probably will go lower in appreciation. The two, do work quite nicely in the vibe. As a currency trader, you are looking for a cheaper alternative, a cheaper expression of dollar CNH, and Aussie dollar usually fits that quite nicely. Spreads are a lot cheaper, and often you see some very, very strong correlation, inverse correlations between the two. If we do get to a situation January 20th, the PBOC know exactly what's happened, what tariffs were put in place at that stage before they staggered higher, then the yuan will probably be depreciated, and that should take the Aussie dollar down. Now, the interesting thing, yesterday's GDP numbers was weak, and the support that we got in the GDP numbers was all coming from government investment. The private sector is weak, households are not spending, we're not seeing that coming through. The saving rates just started to tick up a little bit, but what we're seeing is really some clear evidence that the RBA will probably look to have to cut rates in February now, and there's a line ball call. We're breaking to the top bottom end of this range at the moment. So whilst we've got a bit of conjecture about what happens with the US dollar in the short term ahead of the Fed meeting, obviously payrolls are going to be there, and it's difficult to hold that US dollar exposure over non-farm payrolls numbers. This is at the bottom end of the range. Do we buy it? I can't do it right now. I think there's interesting dynamics that are taking place in the Australian economy. I'm not overly doomsday or negative, but I do feel that we're getting closer to that point where the RBA will probably see enough evidence by February with unemployment rates reports, and then the Q4 CPI numbers that comes out late January, for them to cut rates. Now, I'm a trader, not an economist, so I'm just looking at the risk there. But yeah, I think that's not priced. I think we'll get that information. If the yuan weakens in post January 20th, I think the Aussie dollar is going to be a really interesting currency to look at next year.
Well, why wait till next year, Chris, when you can wait for this year? And instead of buying Aussie, why don't you buy old Betty? Let's take a look at sterling.
Sweaty Betty.
And it's interesting, Chris, and you've probably seen the sterling, rip on the crosses. I mean, the pound Aussie looks good. The pound Kiwi looks great, but sterling as a whole has been holding up very well. And you can see we're in this descending channel. And we flirted today, actually tested the 127.20 level, which is the channel resistance. And just above that is 127.50, which I consider the neckline of the inverted head and shoulder pattern. Now, if it is a complex head and shoulder pattern, that means it's got a diagonal neckline, which you see there. That means it comes in at the 50% retracement at 127.70. Bottom line is we get above 127.20. I think you start buying a little bit. You get above 127.50. You might buy a little bit more. You get above 127.70. You're above the 50% retracement. We're looking at a full-on retracement that takes us well above the 200 DMA. But I like the way sterling acts down here. I like it, and I like how it looks on the crosses. Go take a look at the euro sterling. You'll get my drift.
Yeah. So get on the swing trade if it breaks the neckline. We'll see what happens there. But look, some good setups there. It's an interesting one because obviously the Bank of England are going to sit on their hands in the December meeting, but it looks like they may cut 4 times next year. We'll have to see what happens, but certainly some explicit guidance coming from the great man at the Bank of England yesterday. Anyway, a lot going on. Let's go into our play of the day. Not for everyone. I'm going to look at Euro Aussie now. Obviously, last week I looked at Aussie Yen, and that trade's done all right. I'll probably sort of move to the sideways on that one now. But given that we did hear from the Bank of Japan, there was a sort of an article coming through in the Nikkei or one of the newspapers there yesterday that sort of just poo-pooed the idea that we might not get the rate hike in Japan for December. It's looking like it's probably more a January story. So just taking some of that yen length off the table. But yeah, I like what I'm seeing in Euro Aussie. We held the range lows really, really well. We consolidated. We've had channels there, and we've broken out topside. So I've said, being long euros feels so wrong. You've got the French political situation was absolutely dire. You've got growth, which is disgusting at the moment in Europe on a relative basis. But the Europe, you mentioned it earlier, Blake. I thought it was brilliantly put. I mean, when something is, you feel like it should go down, but it doesn't go down, that's got to tell you something that comes through. And so therefore, the euro is just like you say. It's you can make an argument in euro dollar that it should be trading closer towards 102, but it's at 105, and you've chucked a lot of shit at it, and it holds. So it feels like there's something that maybe it's seller's fatigue, maybe it's just pricing a lot of bad news. But what we see in euro Aussie at the moment is we've broken out there. I think through 164, you look to add on this. So I'm small longs at the moment, looking to cut back on, move below that recent swing low that we just saw, and I'll be looking to add if this shifts up. So whilst I don't inherently like the euro, no one really feasibly could like it in any capacity. What the market and the aggregation of flows and beliefs and things is telling me right now that there is a risk that this continues to push higher. So for me, it's not about what I think about Europe. It's about what the collective are seeing and where the direction of travel is most likely to go to. And so I like this one higher. I think we go to 166. I don't know where it's going to go, of course, but yeah, it feels like the market is telling me a message that needs to be respected here. So yeah, I like this long in small size and be looking to add if this can break through those through 164.
And can I just add something that you don't have on your chart? But if you just connect the tops, that big old long spike you see up there on the left of the chart, all the way down to where we stopped today, it basically stopped right at that line. So in other words, if we get above today's highs, I think your small long should be a bigger long or a broader long. No, a more sizable long. Oh, you know what I'm trying to say.
It's late in the day.
I like it.
Blake. This is where you put your disclaimer.
It's
late in the day.
It's very late in the day. It is extremely late in the day. I've already been doing this for like 13 hours, but let's let you know, and that's probably why I picked up my play of the day, which is Ripple or XRP USD. And XRP for me, baby, You know, I'm not a big crypto trader, but I can't ignore the fact of this move, Chris. This is a big, broad, huge blasting move. And you can see what we're doing is we're consolidating just above the 24% retracement. You see my green box there. The green box basically shows you the 38% retracement, which comes in at 197. And then you go to the 50% retracement, which is also the spike high from last week. I want to say it is November 23rd. Yeah, just before the U.S. Thanksgiving holiday. That comes in around 160 or so. You know, anywhere between 160 and 197. I think that those levels are going to provide great opportunities to be on the long side. This is an impulsive move. Everybody's looking ahead into the new SEC governor. Or chairman, excuse me,
Paul
Atkins, as you pointed out.
Atkins.
Yeah, and you know, this looks like a very bullish move. And whether it continues to new highs from here and above 3 is to be seen. But I believe there are going to be buyers on dips, and I think that I want to be one of those buyers. So those are the levels I'll be looking at, and that's my play of the day, Chris.
Well, mate, I don't want to be rude, but you're getting a bit old to have risk tolerance, you know, in that sort of space. So just be careful out there, mate. So know what you're dealing with.
Where's my cane, youngin?
It's got
it's
got like a 20-day volatility of 150%. So I respect that. But yeah, I don't disagree with you in any capacity. But yeah, I think this is you just people got to understand that the risks. Yeah, you can make 20% in the day. You can probably lose 20% in the day as well. So, yeah, just understand how you're dealing with that and manage the risk according to high volatility assets. But yeah, what it's also told me, Blake, is people's perceptions of returns have changed, but there's been life-changing gains for people, and they don't want to. You know, you go up and tell people, "Oh, you made 28% in the S&P this year." They're like, "I made that in a day in a meme coin." But yeah, look, I mean, obviously these things come with a different risk tolerance anyway. Anyway, Blake, thank you very much again. We'll be back next week for more of the trade-off. So thank you everyone for sticking around. Hit the like button, hit the subscribe button, tell your friends and family about the show, and we'll see you back next week for more of the trade-off.